Welcome to Beat the Bank, the podcast that unpacks how Kiwis actually build wealth. Because for most people, leaving money sitting in the bank isn't enough anymore. If you want to grow real wealth, you need to understand how to make your money work harder through investing, business, and smarter financial decisions. Each fortnight, we sit down with investors, founders, and financial experts to unpack the strategies, lessons, and opportunities behind building real wealth. Proudly brought to you by Venture, helping Kiwis build long-term wealth. Quick disclaimer, this is for general information only, not financial advice. Please speak to a qualified advisor before making any investment decisions. Today's guest is Hunter Dean, mortgage advisor at Venture. As part of the Venture team, Hunter works closely with clients navigating the property market, helping them structure lending, understand interest rates, and make informed decisions when buying property. Through his work, he sees firsthand how everyday Kiwis approach property and where things often go right or wrong. Today we're unpacking how to think about buying property in today's market and what people need to get right if they want to build long-term wealth. Enjoy the conversation. All right, Hunter, thank you very much for coming on Beat the Bank today.
Yeah, no worries. Thanks for having me.
So if someone's thinking about buying property right now, what's the biggest mistake they could make?
I think the biggest mistake anyone ever makes in property is paying too much. You make your money, I believe, when you buy the property, not when you sell it. If you're buying the right property, there's not really any mistake that you can make other than overpaying. There's, in the past, any mistake that you've made has been covered up by property doubling every 10 years. You know, that doesn't seem to be what I see happening over the next sort of 5-10 years. So any mistake is always overpaying up front.
All right, so that makes sense. So if someone's looking to make sure that they're buying at the right time, how do they go about doing that?
Yeah, it's not necessarily about timing the market. It's about looking for those things that you think will make you money down the track in a property. So, is there a new transport link being built within walking distance? Is there a new school being built? The biggest one that will cost you money, is there a block of 20 townhouses that are going in the section next door? Because that's when you're going to lose money instantly buying in that place. And unless you may be thinking about putting up townhouses yourself, then it's, it's not a bad strategy. So it's kind of, what things am I thinking about that in 10 years are going to have helped this property add value without me having to do anything? And then, then you can go into the other add value things. Is this property just need cosmetic renovations that, I can paint the place, I can redo the gardens, add lawn, whatever it might be that you do to add value, you can do it that way as well.
And what makes you say that times may have changed and, that may not be the case going forward? Yeah,
well, I think in my view, the way house prices have doubled every 10 years for the last 30 or 40 years has been a combination of low asset values to begin with. So, a house going from 100 to 200,000 is a little easier to take than a house going from 1 million to 2 million over 10 years. That's whilst it's still doubling, you're talking about $1 million versus $100,000. So there's that kind of exponential growth factor can't continue. And some of what's helped that growth as well as interest rates, if you talk to your parents, they were paying 30% on their loan back in 1980.
Yeah, hear that all the time.
Yeah, exactly.
They don't stop talking about
exactly.
it.
Everyone's always complaining about
30% on a dollar, mate.
Exactly. That's an interesting point, because if you look at real terms and what you were paying as a household for your interest now versus household interest back then is actually the same. So the argument around your parents saying, "Oh, we paid 30%, and you guys are only paying 5%," is not actually a correct argument. It's pretty much the same. But yeah, so if you look at interest rates went from 30 to 20 to 10 to 5, house prices in theory can double every time the interest rate halves because it costs the same. We went down to 2%, 2.5% in 2020 with the COVID pandemic. They've gone back up to 5%. If interest rates halve again, back down to 2.5%. People should have learnt from the COVID pandemic, and we're not going to see house prices go crazy.
Yeah.
But that's human behaviour, and you don't necessarily know what's going to happen.
Yeah. And so you kind of just touched on it before, there are other ways apart from buying and then holding. There's other ways you can make money out of property, like adding value to it, right?
Yeah, correct. Yeah.
And so, in your experience, how have people achieved that?
The only way to really add value to a property in a short period of time is to, do the renovations, add a bedroom. A lot of people in Greyland, Ponsonby, will find a 2 or 3 bedroom villa and push the back out into the section and create a 4-bedroom villa with, a new kitchen and living room, etc. So it becomes a factor of, what are other houses in the area worth? I'm buying this house for $1 million and the neighbouring house is actually worth 2. In that instance, you go, okay, well, it's all worth $1 million because the house is run down and it hasn't had any work done on it. So you can actually quickly add value on that, and you can happily buy knowing that you will be able to add value quite quickly.
Yeah.
So generally, it's the way to quickly grow the asset value is to do the renovation, but whether you never want to overcapitalize as well. A lot of people will get into trouble. They buy a house for $1 million and it needs $1 million of work, and they do that $1 million, and then it's actually only worth 1.8, and they've overcapitalized, and they're now stuck with an asset that is costing them money. That might have put them into a negative equity position potentially, and they're kind of, if you're a developer and you want to sell things quickly after the renovation, that kind of scenario is terrible for you. If you're a person who's buying to refurb the place and do cosmetic renovations and you've overcapitalized, and you might actually be able to hold it for 10, 15, 20 years anyway to kind of get back that overspend early on.
Right. So what are some of the places in the house that someone should be, changing to make sure they're getting the most out of it? Imagine putting in like a man cave with a,
I mean, that would add value for me, wouldn't it? I'd be happy
definitely.
about buying something with a man cave. But yeah, I mean, so what should you look to do when you are, looking for a property that you can refurb? I went in and had a look at a place yesterday. I went in there, beautiful house. The floors had been resanded, bedrooms, bathrooms were all great. Kitchen hadn't been done for 25 years, and they wanted a pretty high number on the property. So I think it's always the communal living spaces, the kitchens, the bathrooms, that type of thing. If you can find a place that is, relatively good value and do a bathroom or a kitchen renovation for not too much, that should quickly add value to the property. And then you obviously, if you can add bedrooms, if you can add living spaces quite easily, then that quickly adds value to the property as well.
Right. And so once the person has added value, what can they do with that? Is there anything they can...
Yep, so a lot of people who are trying to quickly grow equity and move to buying the next place will do that renovation, get it revalued, so get a professional valuer in there to show that they've moved the property from $1 million to $1.5 million, say. That obviously has increased their equity position as far as the bank's concerned. They can then use that equity to purchase another property and help them without needing any more cash. They can then, use that extra equity towards buying their next property and borrowing more money on the back of that.
Right, okay. I suppose it's difficult, right? Because a lot of how people feel about buying property is driven by what the market's doing. And so back in 21, you'd ring a real estate agent and they go, oh, sorry, we've got too many people coming through the house, so we can't even have you come through. And they're like, don't even bother putting an offer if it's at this point,
Yeah.
And if you've got cash and you're like, crap, this is going to be the next kind of 10 years. You've just seen markets double every 10 years before that. It's just such a difficult decision to make because your emotions driving a lot of the behavior. And then now, it's all really negative. You know, everything you got the oil going up massively as well. And so that kind of drives your behavior as well, right?
Yeah.
Maybe clouds some of your thinking.
Yeah. And I think it's a lot of people get lost. Like if you're a first time buyer or you're buying for your family, it's a really emotional purchase, and the whole family falls in love with the house, and you don't want to lose that house because everybody loves it, and you forget that what you're actually doing is a financial transaction, and you need to treat it that way, and you need to go these are my metrics. This is what my income allows me to buy. This is what I should be paying. Some people can always go higher than what they've been approved at the bank, and that kind of drives them to at an auction when they're getting excited and going against another family and they want to beat that family. they get excited and spend more money than they probably should have, not kind of thinking about it being a transaction, and there will be another house that they like in 4 more weeks potentially that comes to market. So you don't have to go above and beyond for that property. But that kind of scenario brings you right back to you make money when you first buy your property. And so I'm still seeing, I go to auctions every now and again just to have a look what's going on, and good houses are selling right now and they're getting good money. Mm-hmm. Houses where there's defects or things wrong with them, or the area's not right, or there's a townhouse development that's gone in next door, those are the ones that are not selling, and people are just kind of, or the current owners are really just wanting to hold on to them and haven't adjusted their value down from what it was in 21, 22.
Mm-hmm. Yeah, I feel like that's a really good point to make for the audience to understand, because it's not just like what's happening around us in terms of the market and the economy and how that affects prices, but it's also, if you actually just buy a really good asset, you've actually got a better chance that asset's going to hold its value.
Exactly. The more things that the property has going against it, I think my first house, I bought it with a cross lease on it, and everybody kind of was like, oh, you've bought a property with a cross lease. And there was a real stigma around it kind of 5-10 years ago, whereas now I kind of look at a cross lease as like, actually, houses are also close to each other anyway. If you can be in control what your closest neighbour is doing because they're restricted by the cross lease, it's not necessarily a negative thing, and people have started to kind of get their heads around that a cross lease is not the end of the world.
All right, and just to move a bit away from property now and more into interest rates and what people should be thinking about, lifestyle can affect what rates you should choose.
That's a great point, that it goes to your individual situation. You might be very happy right now to have certainty for the next 5 years, and you'll pay a premium on that, and you'll be paying 5.5 instead of 4.5%. But you may be laughing in the end. I know a lot of people back in 2021, you could get a 5-year rate for 2.99%.
Ooh.
Very few people actually did that, because the rates were so low, and it was, people didn't want to lock in at 2.99, which is a high rate, when you could get a 12-month rate that was 2.25. I think the 2020 period to 2022, 23 is just such an amazing learning for our generation. Mm. It was obvious in the end that COVID wasn't having the effect that it was meant to have on the market, and why the Reserve Bank kept the interest rates so low is beyond belief, because the housing market was just going ballistic, and it was obvious that it was a bubble, and they seemingly did nothing about it, and the economy was still going along just fine.
What percentage of mortgages are on like a 1 year or floating? Or
very few people float, because the floating rate is more expensive than the 6 and 12 month rate. And a lot of my clients are fixing for 12 months. Some are kind of splitting their loans and hedging their rates a little bit, fixing half for 12 months and half for 3 years just to get some certainty, but also have that ability to be paying a lower rate and take advantage of that. There's so many different ways you can do it. Some banks offer an offset account where if you've got some spare cash, instead of paying the mortgage off, you can have it still sitting in your bank account and reducing what your interest costs actually are on that loan. So there's numerous strategies that.
So if someone's earning like 120K and they've got a bit of money in the bank, and they, how do you kind of steer them in the right direction?
In some respects, it's not for me to steer them to what they should be doing. I'll always talk about, I'll give them an indication up front around what they can actually borrow. There's some simple metrics that we can use that I can, with 30 seconds of questioning your income and what your outgoings are, I could give you a relatively accurate ballpark figure.
So someone on 120K per year could borrow how much?
Well, the max they could borrow is 720K.
Right.
But then you've got to factor in, do they have kids at daycare? That's going to drop their borrowing capacity down. Do they have car loans? Do they have personal debts? What are their credit card limits? There's so many things that kind of.
So that's the starting point.
Yeah, starting point is 6 times, because that's all the Reserve Bank will allow.
Yeah.
And then the more expensive your life is, knock money off every time you're spending money consistently every
Netflix,
month.
10 grand gone.
Yeah, exactly. Yeah, exactly. Yeah. Coffee's
Gone.
Don't even borrow.
Yeah. Unknown credit card bills gone.
Yeah, exactly. But the notion, so I think, in 2021, what they call the triple CFA came into play, and that was kind of an unintended consequence of that was that the main banks lending you money to buy a house fell into the triple CFA requirements, and the banks were literally going through every single transaction in your accounts and questioning you on it and whether that was going to be a spend ongoing into the future. But that's kind of cooled down a little bit now, where the banks will kind of benchmark what they think a 4-person household's monthly spend is. If you spend more than that and have regular fixed costs, then that'll go up. But if you spend less than that, you have to kind of put a position forward as to why you think you spend less than the benchmark.
Right. Okay. And does that same kind of multiple on the income and the borrowing capacity apply to all types of, property, or is that just like if you buy your own home? What if you want to buy?
If you're a property investor, it goes up to 7 times the income as the cap. There's always
Is that because you're getting rental income?
No, it's more just because it's a second home, so they allow you to borrow a little bit more.
Oh, that's nice of them.
Yeah, well, I mean, if you think about it, though, like 7 times, if you own a house with a mortgage on it already, and then you're trying to buy to borrow another one, it's a pretty restrictive kind of covenant that they're putting on it.
Yeah.
There's a 7 times cap that property investors fall into, which, like I say, there's always exceptions. It doesn't. If you've already got the lending and you're trying to refinance, it doesn't matter. It's just for someone new that's trying to come into the market, they review that cap. And I say there's always exceptions to every rule, and sometimes you might be able to get around the caps that are there. But you need to work with the bank around what's viable and what you can actually do.
And does the bank have a requirement on how much money you need to be putting down?
They've actually just changed the rule for investors. It used to be 30%, cash or equity from an existing property was required to buy an investment property. They've just relaxed the rules a little bit around the affordability part, and therefore the banks can use their discretion if they'll let you borrow money for an investment property up to a higher LVR portion. And there's always been, there has been for the last few years, around new builds. If you're buying something that's been built or has been built within the past 6 months or is being built, you only need to put 10% down, whether you're an owner-occupied or a property investor. That's just to encourage people to build new homes and buy newly developed homes and whatnot. And I actually think as a property investor, buying a new build property in the right area is not a bad strategy. You kind of, you've got a new house, for 10 years, if the right company's built it, you've got a master build guarantee. So any maintenance issues in theory are going to fall back to the builder. So your only worry is to make sure you have it fully tenanted. And there's a lot of, property management companies these days that will offer you a rental guarantee of 1, 2, 3. I heard one that did 5 years the other day.
Wow.
So if you haven't got the property rented, they'll guarantee you that it's rented.
Yeah.
Which obviously takes a big worry off a lot of new property investors' shoulders.
Yeah. I tend to agree, but the only thing I would say is I don't know if the capital gains is good though, right? And also in the current times that we're having where the market's a bit flat, I was reading in the paper the other day that a lot of the new build townhouses are a lot harder to sell.
Yeah, certainly if you're buying a townhouse, I think that goes back to the point that I made at the start around is you make your money when you buy the house initially. I think if you're buying a townhouse as an investment property, you're doing it for rental yield, not for capital gains per se. And so a lot of property investors, the previous strategy was to just borrow all the money, put it on interest only, and in 30 years, you sell the property and you've tripled your money and you pay back your loan then. Whereas my point of view would be that, over the next 10 or 15 years, property is not going to gain that much. So you actually need to be in a higher yielding investment property and using some of that additional rent to pay down the principal. So at the end, you've got a mixture of capital gains and a reduced loan to, get your money back from.
And in your opinion, if someone had, I don't know, $1 million in cash, do you think they should be buying property outright, or they should? What do you think they should be doing?
I think it depends on the time. $1 million cash obviously is a great position to be in. I'm a firm believer in like leveraging yourself makes you wealthier in the long run.
Yeah.
But obviously, if you're paying a 7.5% interest rate, you've got to weigh up whether that $1 million that you don't put into the house is going to earn you more than 7.5%, depending on what fund you're in. So in a higher interest rate environment, you might decide that actually buying the house outright is the better thing to do. But if you're paying 2% interest, then you're better off having as much money as you can in the share market, making you 7.5% to 9% a year, than reducing your interest payments by 2.5%.
Yeah, I think that's a really good lens, because what you're basically saying is you're comparing the interest rate that you get, that you have to pay to the bank, versus the return you get in the share market. That's you're going to get capital gain on the property either way, right?
Yeah,
but
exactly.
The difference is in comparison, and that's also important for other people who have investments now in like KiwiSaver and stuff like that. And if they've got maybe $200,000-$300,000 in KiwiSaver, and they're invested in like a balanced or growth portfolio, and in a balanced portfolio you have about 40% in fixed income, which is getting you 4.5, and a growth, you 20% in fixed income.
Yeah.
On one hand, you've got the mortgage debt, and then you've got an asset in your KiwiSaver that's not actually earning more than what you're paying on your mortgage. I mean, obviously you can't take it out and pay it off.
Yeah.
But in a kind of building wealth way, that's a really important kind of opportunity cost to weigh up.
Yeah. Exactly. It's and that's all around being diversified. If if you've got 300K already in KiwiSaver and in the market, then you might actually be better to buy 2 rental properties and have leverage, put 500K of that $1 million against each property, and you've got 2 properties earning you money that way as well, rather than just having $1 million against one property that's earning you gains.
Yep. And what happens to people who sit on the sidelines for too long? They call that decision fatigue.
I mean, I think in the last 5 years you've gone ahead, haven't you? So, what do you deem as too long?
Who's the idiot now?
Yeah, exactly. So I don't think, there's no such thing as sitting on the sidelines for too long. Obviously, in 2021, people thought sitting on the sidelines for 6 months was too long, and they would, and it was at that point, because everything had gone up 20% in the space of 6 months, and you were behind. Whereas now you're sitting there, you might be, if it takes you a year to buy a house, you've saved a year's more money. You've, taken your time to consider what properties are selling really well and which ones aren't, and you're becoming more knowledgeable, and like you alluded to, you do get fatigue, and I can see that, and it's going to open homes every weekend is pain, really. But you need to remember that this will, for a lot of people, buying a house is the single biggest transaction they'll ever do, and so you can't approach it with a feeling of fatigue and boredom, because in 5 years' time, if you're trying to sell, I can tell you fatigue and boredom will change to stress and anxiety, because you lost money, or you can't sell your house, or whatever it might be.
Yeah. All right. So just last question. Obviously, here we're teaching our listeners how to beat the bank. So from your, personal and the way that you invest, how can someone go out there and beat the bank?
Well, I think the most interesting thing for me that I've learned being a mortgage broker is it's not just, you've borrowed $1 million and you've got a 5% interest rate and that's what you do and you fixed it for 1 year. There's actually, every bank has different products that you can use in different ways to, pay your loan down faster or reduce the interest that you're paying, which in turn helps you pay the loan down faster. So The banks are made up of hundreds and thousands of very intelligent people, so there's no such thing as beating them per se, but you definitely can come up with strategies that will reduce the interest that you pay over time, which you can then reinvest into growing your assets. So for me, beating the bank is using the bank's leverage to help you grow your wealth.
Great. So yeah, I mean, that makes complete sense. I mean, when we talk about beating the bank, we're talking about, people who have got maybe just cash sitting idle, or people who are just sitting idle in property with large mortgages. And so, everything you've covered off today from different ways of investing in property and reducing mortgage rates and interest rates, I think is going to be really valuable. So thanks, Hunter, for coming on.
No worries. Thank you for having me. Enjoyed it.
Thanks for watching another episode of Beat the Bank. If you want help building long-term wealth and getting your money working harder, feel free to reach out to me or the venture team for a chat. We'll see you in the next one.